This is Macro Horizons, episode 368, second quarter Quagmire, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of April 6th. And as we say goodbye to March, we're reminded that tax day is quickly approaching, and we're preparing for our annual pilgrimage to Boston Harbor with our colleagues Earl and Gray. We're looking forward to the party. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the bulk of price action in financial markets across the board was a function of developments in the Middle East. One of the more interesting aspects of the move was the fact that after 10-year yields peaked at 4.48 last Friday, the market subsequently rallied rather significantly as the market's focus shifted from trading the conflict in the Middle East entirely as an inflation story to beginning to worry more and more about the implications for global growth. Progress in Iran also refocused the market on the importance of the Strait of Hormuz and the potential for a longer-term resolution. Taking a step back, it's clear that the market's focus is shifting beyond the initial stages of the conflict and instead emphasizing how the global economy may perform after the fact. As headlines from the Persian Gulf continue to set the stage and redefine the market's reaction function to the economic data, it was unsurprising to see that, by and large, the Treasury market, and frankly equity market as well, were quick to look beyond any of the economic data. Notably, on the consumption front, we saw retail sales increased 0.6% month over month in February. That compared to the 0.1% drop in January. Perhaps more importantly, the control group gained an impressive 0.5% in February compared to 0.2% in January. This was the strongest showing for the control group since October. Recall that investors tend to focus on the control group because it has the highest correlation with consumption within the real GDP figures. Moreover, this suggests that any early indications that the consumer was pulling back at the beginning of the year have been offset by the solid February numbers. It's worth reiterating that this was February's data, so it preceded all of the uncertainty created by the war in Iran, and as such, the market seems comfortable dismissing it as dated information. The same could generally be said for the economic data on offer in the week just past. We'll highlight that in terms of monetary policy expectations, the futures market has shifted from pricing in a non-zero probability of a rate hike in 2026 back into pricing in lower Fed funds by the end of the year. This shift has been accompanied by a solid bid to the front end of the curve, and as a result, the curve shape has been stable, with 2s10s effectively anchored at 50 basis points. So as we've seen a parallel shift lower in rates, it begs the question whether or not it's time to re-engage with a steepening bias. We maintain that it's still too soon for that shift, but as with the rest of the market, we will be closely monitoring the price action over the coming week.
The price action in the rates market and markets broadly, whether it's commodities, equities, credit, mortgages, all continues to be defined by sentiment surrounding the war in Iran and the likelihood that the conflict is going to drag out for another several months, or the probability that Washington's appetite for the conflict continues to wane and the conflict concludes sooner rather than later. The shortened trading week just passed was a prime example of precisely this dynamic, as early optimism following Trump's comments around wanting to end the conflict regardless of what happens in the Strait of Hormuz was only reversed by Trump's speech on Wednesday night, which was interpreted as far more escalatory and increasing the risk that the distortions around the shipment of oil are going to persist for the foreseeable future. At a minimum, we're comfortable one thing is going to stay elevated, and that is the level of uncertainty and overall volatility, which will continue to determine whether 10-year yields are trading closer to 4.50 or 4%.
And at the end of the day, even once the conflict is eventually resolved, regardless of how the situation ultimately unfolds, there will be a new, higher floor for energy prices that will likely persist for months, if not years. The logic here is relatively straightforward. The amount of destruction that has been done to production facilities in the Persian Gulf region is going to anchor energy price expectations higher for the foreseeable future. What is less clear is the market's willingness to trade this entirely from the perspective of higher energy prices leading to inflation versus beginning to ponder the impact on global growth. What we have seen recently is a shift away from solely the inflationary implications to consider a more balanced approach, which the resulting price action was a modest bid in the Treasury market that brought 10-year yields back to 4.25. However, the spike in energy prices that followed Trump's speech on Wednesday evening served to rebase energy prices at a higher plateau. As we consider the key risks for the second quarter, top of the list continues to be the conflict in Iran and the pass-through to the global economy. The recent economic data has reinforced the narrative that the U.S. economy remains resilient, all things considered, and while we did see an increase in the prices paid component of ISM manufacturing, overall sentiment remains stable, if nothing else.
And from the Fed's perspective, what we're increasingly hearing is that the balance of risks between the labor market and inflation are increasingly shifting back toward balanced and away from what was a definitive one-sided concern around the state of the labor market. Even after March's payrolls data, the Fed is going to be reluctant to react too dramatically to a single month's worth of jobs data, but nonetheless, as the central bank gets a clearer picture on the state of hiring and the persistence of the low hiring, low firing paradigm, the order of operations of the feed-through of higher oil prices to inflation, growth, and ultimately hiring is important to consider. As we think about this order of operations, obviously the rally in oil and $110 a barrel crude is going to first influence market-based inflation expectations. The reaction in break-evens has demonstrated this much. And then we will likely see a pickup in realized headline inflation and survey-based inflation expectations before there is a risk of more material flow-through to core goods inflation, which will add to the tax on consumption feedback loop and ultimately be the mechanism by which we see growth move lower and the pace of hiring come under greater pressure. Now, that roadmap is not a process that's going to play out in a matter of weeks, but instead we're thinking of this timeline more along the lines of the next several months or the next several quarters, frankly, even over the balance of 2026, and it's that sequencing that's important to consider as we think about the outright level of yields and timing the potential inflection point. While yes, we saw 2-year yields at 4% as an attractive buying opportunity, that's not to say that from a departure point of 375, there isn't scope for a renewed round of front-end bearishness in response to higher inflation expectations and a potentially near-term more hawkish Fed, even if ultimately we anticipate the easing bias is going to persist and the Fed's monetary policy actions, especially under Kevin Warsh, will continue to be primarily dictated by worries around the labor market.
And as we think about the next few weeks, we'll be closely watching the incoming Fed commentary as the war in Iran extends, energy prices push higher, and the risk of pass-through to the real economy increases. Thus far, the messaging has been very consistent from monetary policymakers, and that is that events in the Middle East have introduced a degree of uncertainty that is best addressed by monetary policymakers by delaying any future rate cuts. Now, while some committee members might believe that there is symmetry at current policy rates, i.e. the Fed could cut, but the Fed could also hike, the vast majority of the committee appears to agree with Powell insofar as, in practical terms, the most hawkish response that the Fed will deliver to the current situation with Iran is to delay the process of normalization. From our perspective, we continue to anticipate that at some point this year, the Fed will once again start cutting rates. most likely in 25 basis point increments and staged out over several meetings. The biggest wild card isn't whether or not the Fed is going to hike or cut, but rather it's the timing of the departure point for resuming normalization. So, assuming that Warsh is able to build consensus around the notion that future reductions in the balance sheet coupled with lower policy rates is the most prudent path for monetary policymakers, then it follows intuitively that one could see rate cuts as soon as this summer, and if not, then likely in Q4. All of that being said, it isn't lost on us that the real economy continues to demonstrate a degree of resilience that has complicated the job of monetary policymakers. There are also open questions regarding the current tariff structure, whether or not prior tariffs will need to be paid back, and if so, how will the Treasury Department fund such refunds?
And in thinking about the ultimate resolution, not just to the war in Iran, but also the medium and longer term trajectory of yields from these levels, we're in a paradigm that's not entirely dissimilar from what we experienced in the third and fourth quarter of last year when the government shutdown delayed all the economic data, left investor conviction very light, and kept Treasury yields in an increasingly well-defined range. Now, obviously, we have a partial government shutdown underway. That's not impacting the economic data. However, for all intents and purposes, we might as well not be getting any economic data, given that on the one hand, in many cases, it's going to be stale and not reflect the uncertainty brought on by the war or the reaction in commodity prices. And on the other hand, the market is frankly not really concerned with how the economy performed last month. What is much more relevant is the likelihood that the Strait of Hormuz is open for business at any point in the near term. Now, the outright level of volatility is certainly higher during this current episode than it was during the government shutdown, and so that will likely translate to a wider trading range in Treasury yields, but a range nonetheless, until such a point that we have greater clarity and investors' attention will turn back to the economic fundamentals, which we anticipate will ultimately be the driving force in determining the direction that rates ultimately break. We expect that's going to be a 3-handle tens, not 5-handle tens result, but at this point the question has become far more one of timing than actual details of however it is the war ultimately comes to an end.
And it's also interesting to note how well equity prices have performed in this environment. Sure, the S&P 500 is down year to date, and yes, we have seen an increase in realized volatility in stock prices. However, taking a step back, the net of the price action has overall been relatively benign when we put things in the context of the war in the Middle East. One might have otherwise expected that an energy shock would have led to greater concerns about a recession in the near term, either in the U.S. or globally, and that would have translated through to a rebasing lower in terms of equity valuations. What we've seen thus far is that sell-offs have been contained within a reasonable range, all things considered, and as a result, the wealth effect will most likely continue to fuel consumption, as well as afford at least the upper quartile of households to absorb increases in consumer prices, particularly headline inflation.
So it's really going to be a staycation summer.
Well, I've got nowhere to be and no way to get there. In the week ahead, the Treasury market will have an array of fundamental inputs, although, as has been the case, headlines out of the Middle East continue to set the agenda for financial markets more broadly. Nonetheless, we'll be focused on the highlight, which is Friday's release of March CPI. Expectations are for a sizable increase in headline CPI given the influence of elevated energy prices on gasoline costs as well as other aspects of the energy sector. That being said, core CPI is seen up just 0.2%. We'll also see the February core PCE figures, which are seen increasing 0.4% on a month-over-month basis. Now, this is the Fed's preferred measure of inflation, and there has been a notable divergence between core PCE and core CPI, which, if nothing else, has contributed to the Fed's willingness to stay on hold and wait for further clarification before resuming the process of normalizing monetary policy rates. We also get the release of the March FOMC minutes, which should, if nothing else, outline the Fed's thought process that led to keeping rates on hold and serve as an opportunity for the Fed to better help the market understand how it's viewing the risks associated with the war and the potential flow-through of higher energy prices to the U.S. economy, whether that's initially viewed as a tax on the consumer or if there are building concerns that from a longer run perspective, this will add yet another inflationary underpinning. And with that backdrop, we also have a series of auctions. On Tuesday, 58 billion 3-year notes hit the market, followed by Wednesday's 39 billion 10 years, and capped with the long bond auction on Thursday, which will be 22 billion. Looking at the auction performance during the final full week of March, one might assume that there is flagging demand for Treasury securities at the moment. Instead, we're reminded that auction performance tends to be more highly correlated to the amount of volatility that's in the market at a given moment, as opposed to a referendum on Treasuries as an asset class per se. Using this framework and looking ahead to the upcoming auctions, if the market continues to stabilize and we go into the 10 and 30-year auctions in a relatively familiar range with a reasonable concession, either outright or on the curve, we expect that the auctions will be taken down well and largely be a non-event. As we watch the price action itself in Treasuries, we are encouraged, especially given that we have a medium-term constructive bias on U.S. rates. We take a fair amount of solace from the fact that it appears that the local peaks have been established for 10 and 30-year rates, which bodes well for a further consolidation over the next several weeks as the market continues to assess the forward implications from the conflict in the Middle East. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. This brings us to the perennial question, how do you make Good Friday into Great Friday? SIFMA knows the answer, but the official recommendation is still just an early close. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.